Okay, so the Federal Reserve just made a move that's going to send ripples through the whole economy. We're talking everything from your savings account to what you'll pay for a new car. But this isn't just some simple up or down vote. No, this is a high wire act, and we're going to break down exactly what it means. Let's get into it. So this is the big question, right? After a whole series of cuts meant to get the economy going, why slam on the brakes now? Well, the answer is complicated. It's a fascinating mix of conflicting economic data, some really calculated risks, and, yeah, a whole lot of political drama. All right, first things first. Let's cover the headline news. What did the Fed actually decide to do in its first big meeting of 2026? They hit the pause button. Simple as that. No cut, no hike. They're holding that key short-term interest rate steady, the one that ends up influencing stuff like credit card rates and car loans. Now, a lot of economists kind of saw this coming, but it's still a really big deal. It signals a major shift in their strategy. And you have to remember, this pause comes right after 3 straight rate cuts back in late 2025. For months, the Fed had its foot on the gas, trying to stimulate the economy. Now, by holding steady, they've basically shifted gears into neutral. It's a classic wait-and-see approach. But get this, it was not a unanimous decision. Not even close. 10 members voted to hold steady, sure, but 2 of them actually wanted another cut. That split tells you there's a real, live debate happening inside the Fed. It's a huge sign of just how uncertain they are about where the economy is really headed. Okay, so that's the what. Now for the why. Why pause now? Well, it all comes down to this incredibly delicate balancing act the Fed is trying to pull off with the entire U.S. economy. This slide really just nails the whole problem. On one side, you have Fed Chair Jerome Powell looking at a labor market that's starting to look a little shaky. That screams cut rates to try and create jobs. But on the other side, there's this nagging fear that inflation could get worse. And here's the kicker. You can't use the same tool to fight both of those problems at the same time. And you don't have to take my word for it. Fed Chair Jerome Powell said it himself pretty bluntly. He's basically saying, look, if the job market is weakening while prices are rising, the Fed is trapped. That's what he means by a very difficult situation. And that is exactly why they're hitting pause, to wait and see which of these 2 big forces is going to win out. I mean, just look at the dashboard the Fed is staring at. It is a total mixed bag. You've got labor growth slowing down. That's a warning light. But then the unemployment rate is holding steady. Inflation is easing a bit, which is great, but the housing market is still pretty weak. And then you have to throw in all these wild cards, like what's happening internationally or the threat of new tariffs. It's a super complex picture, and there are no easy answers here. Okay, I know all this economic talk can feel a little abstract. So let's bring it all back down to earth. What does this Fed decision actually mean for your wallet? This is the big one, isn't it? The question on everyone's mind, is my mortgage rate going to go down? Well, unfortunately, the answer just isn't that simple. As one economist at Realtor.com put it, what we've seen recently is a textbook reminder that the Fed doesn't have as much control here as you might think. It's a really common misconception, but the Fed doesn't directly set mortgage rates. Remember, they control that short-term rate. Mortgages are long-term loans, and they're way more influenced by things like the 10-year Treasury yield and just general confidence in the market. In fact, a lot of the time, those long-term borrowing costs, like for mortgages, are swayed more by things that have absolutely nothing to do with the Fed. We're talking about stuff like escalating tensions overseas or new housing policies being debated in Washington. So, yeah, the Fed's decision matters, but it's really only one piece of a much, much bigger puzzle. But this whole story isn't just about the economy. Believe it or not, there's a pretty intense political drama playing out behind the scenes. And it's all about whether the Federal Reserve can even remain independent. You really have to look at the timing of events to get the full picture. So, late 2025, the Fed cuts rates 3 times. Then, not long after, in early 2026, the Department of Justice launches an investigation into Chair Powell. It all comes to a head at a press conference where Powell comes out swinging, fiercely defending the Fed's independence. And this is a really serious accusation. Powell is basically calling the whole DOJ investigation a sham. He's saying it's just a pretext, an excuse for political payback because of those rate cuts he made back in 2025. It's a huge deal. So Powell's defense here is bigger than just him. He's defending the entire idea of an independent central bank. He calls it an institutional arrangement that has served the people well, not just here, but in democracies all over the world. He's basically warning that if politicians start interfering, it could permanently wreck the Fed's ability to do its job. So that's where we are. The Fed is walking this incredibly thin tightrope. You've got a fragile economy on one side and this intense political pressure on the other. The big question now isn't just about what their next move will be, it's about what happens if they fall.